Assalamu alaikum and welcome to yet another episode of Edward's IFRS Practical Issues series. This is episode 5, and today we'll be discussing another important issue that was sent to us through our query forms that we generally share for any issues that you might be encountering. This is Sana Kadri, and I'll take you through the query and we'll solve it together. So starting with the query that was shared with us, let's just read the case through. Shakir and Sons was established by Verizon Investments and its shareholders undertake the government obligation in developing the logistic lands with Verizon Investments concession area, as well as to market and commercialize the logistic land. Further, Section 8 of the concession agreement enables Verizon Investments to enjoy the access of the developed logistic land that will be provided by the government, and Verizon Investments shall then optimize the use of the land by leasing it to the clients. Initially, the government developed 65 hectares out of 22,000 hectares that is granted as set out in the concession agreement. Verizon Investments was successfully able to lease out the developed land of 65 hectares within 4 years, which triggered a business demand for the government to hand over for the more developed land to Verizon Investments to pursue its commercial logistic activities. The government was not successful in fulfilling its obligation of land development due to the economic crisis experienced in 2018. Alternatively, the government represented by Free Zone Authority has agreed with Verizon Investments to pass on its land development obligations to Verizon Investments or a special purpose company established by Verizon Investments, currently being Shakir and Sons, to privately fund the development works and enjoy the full rewards which goes along with the continuous development, marketing, business, and financial risks that will be occurred to develop the logistic area at Verizon Investments concession area. As per Article 8.3 of the concession agreement, the development of logistic area does not entail leveling the land only, but all works required that the government was going to perform in order to make the logistic area marketable and leasable throughout the concession term, meaning all annual works are required, such as providing utilities, construction of road, and all of its relevant expenses and consumables to upkeep the logistic area in a marketable and leasable condition throughout the term. The obligation of Shakir and Sons extends to cover all the commercial activities to market and lease the land throughout the term. Arrangement between Verizon Investments and Shakir and Sons is that pursuant to the framework agreement, Verizon Investments has granted Shakir and Sons an exclusive right to develop and market the logistic area under the Master Development Agreement, which reflects the stated above responsibilities. The principle of granting Shakir and Sons an exclusivity right is to ensure that the development project remains financially viable despite the challenge of low rates that may be chargeable to clients in the remote area that we are discussing versus the large investment cost required. Hence, an exclusivity right is granted to Shakir and Sons to secure annual sufficient monetary consideration to cover the necessary annual financing costs, commercial and marketing costs, as well as the maintenance expenses that pertains to the works required in the logistic area. In the light of the above, how should we recognize the following under the books of Shakir and Sons? Development expenditure incurred for land leveling, land filling works as an asset or expense under which IFRS standard. Land lease rentals revenue under which IFRS. Okay, so this was a long question, very lengthy question, and there's a lot of information at the same time. One thing that I wanted to mention is that we have changed the names of the companies involved, the special purpose vehicle involved, just because we don't want to disclose whoever the person or the company is approaching us for the query, just to ensure the confidentiality of people asking us for help or support. Now let's break down this entire case study, as we call it, in smaller chunks and pieces, understand what it actually is and what the concerned person is asking us about. So let's understand from this diagram that we have made is that Verizon Investments is an investment company, right? So government, basically what they did is they first entered into a concession agreement with Verizon Investments, where they basically provided them a specific land, right, of a particular area, because they wanted, it's probably a remote area, it's not very well developed. They wanted Verizon Investment to market it in terms of obviously generating revenue out of that, remote or barren land. So the agreement was such that the government was initially responsible, developing the land so Verizon Investments could market it and lease out the land. But later in 2018, government, till 2018, government could only develop 65 hectares of land, which was completely leased by Verizon. And obviously in 2018's financial crisis, the government understood that they were not in a position where they could actually finance the entire development of that area. And then they actually got back to Verizon Investments. They asked them to basically finance the development, and as well as, they leased it out to Verizon to basically lease it at the same time so that they could use the land, develop it, and at the same time earn by leasing out the land to its customers. So first was a leasing agreement, then they asked them to develop it also. So what Verizon did, because Verizon is not a construction company. So what they did is that they created an SPV, a special purpose vehicle by the name of Shakir and Sons, whose responsibility was to develop and commercialize the land that was given. It was initially 65 hectares, but then they gave the entire 2,000 hectares to Verizon, which was again delegated to Shakir and Sons. So Shakir and Sons, what their responsibility was to develop it and then to lease it out, generate revenue out of that land. So this is basically the whole structure of the transaction or the event that we are discussing. Okay, so now let's move on to the questions that the person asked. So the person asked, the very first question that the person asked was, development expenditure incurred for land leveling. They wanted to know if that land filling works can be capitalized or it has to be expensed out under the IFRS. For that, let's just look into first what is the business of, okay, we've discussed the business. Let's look into IFRS 16. IFRS 16 is the one that basically determines the initial recognition, measurement, and subsequent recognition, and of course, disclosure requirements of property, plant, and equipment. The question is again about development expenditure of land under IFRS 16. Let's just look into what IFRS 16 specifically says about costs that have to be capitalized. Para 16 of IFRS 16 defines elements of initial costs. Any costs directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended by management, right? So these are the elements of costs that have to be capitalized in the assets cost. Subsequent costs of repair and maintenance in nature are not recognized in carrying value of assets. So what we have to understand is that when we are talking about a land as an asset, so basically a land has to be leveled, and you have to, there needs to be some work done on the land in order to be able to lease it out to the customers. So all that works that basically would add to the value of the asset, so that the asset could be handed over or that could be acquired by the lessee is actually the cost that needs to be capitalized. When any subsequent costs, such as repair and maintenance costs, it could be basically maintenance cost of the land, that has to be expensed out. But the first cost that's incurred to actually bring the land into position where it could be handed over to the lessee, that cost is particularly has to be capitalized, right? So that would mean that land leveling cost, of course, is something that needs to be done. Otherwise, there would not be there'd be no customers for the land. And obviously, they might need to create some maybe roads alongside. So that might also be looked into and have to be capitalized. That was about the first question. Now let's move on to the next question. Now the next question asks whether the lease arrangement or the revenue from the lease arrangement that Shakir and Son as an SPV would be earning, should it be classified as income revenue under IFRS 15, or it should be capitalized? It should be recognized under IFRS 16 at these arrangements. Basically, one thing that I would want to mention here is that we don't have access to all the information about what the contract is about, what are the other details that we need to look into to see if it needs to be classified under IFRS 16, or if it does not qualify for IFRS 16 or not. So we don't have that kind of detail. What information we have right now, we'll be basing, be putting our decision, or you can say suggestion, based on that information that we have. So let's look at Shakir & Sons. What is the business of of Shakir & Sons? Shakir & Sons is an SPV which is solely created, basically develop the land and then lease it to the customers. It is not a financial institution, right? And leasing of asset is not one of a transaction of Shakir & Sons. This company is solely an SPV for this particular process, develop and lease up. So that would mean that the revenue from the leasing of the land would be classified under IFRS 15 based on the information that we have right now, and based on the kind of the transaction that we understand from whatever information was discussed. This was about the second question of under